Welcome back, everybody. Well, the markets are super crazy right now and the daily fluctuations are higher than I have ever seen. On one day, the S&P 500 is falling down by 4 or 5% to immediately jump up by almost 10% on the next day, and then just one day later, fall by 3.5% again. And just to put this into context, these daily fluctuations are in the range of the average yearly long-term market returns for indices like the S&P or the MSCI World. So understandably, investors are pretty nervous and scared right now. And obviously, this is driven by the thumbnails of Graham Stephan that have turned all red and fiery again. No, just kidding. Of course, it is the erratic economic and political news coming from the US on a daily basis right now. But there are 3 indicators that I like to look at that help me to keep my confidence and tell me where the market is standing. And today, I want to share them with you. The first one, and probably the best known of the 3, is the VIX. The VIX is the volatility index of the S&P 500 that represents the market's expectation for the volatility over the next 30 days. The correct calculation is quite complex, but in short, they use near and next term put and call options with more than 23 and less than 37 days on the S&P to determine the expectations of investors for the next 30 days. So it is a forward-looking index that shows the level of risk, stress and fear in the market. Generally speaking, it tends to rise when stocks fall and declines when stocks rise. This is a bit similar to the Fear and Greed Index, which you might also know, and the Fear and Greed Index indeed uses the VIX as a part of its calculation. And by the way, the Fear and Greed Index is currently sitting at a pretty low rating of 20, which indicates extreme fear or pessimism in the market. But back to the VIX. This index hit its highest levels since August last year, and in recent history, it has only been higher in the COVID crash and after that in the financial crisis in 2008. In my chart of the VIX here, I have marked 2 lines, one at 30 and one at 20. Because as a rule of thumb, values above 30 show a large volatility and high uncertainty, while values below 20 show stable and stress-free periods in the market. Now, please don't stress too much when the index goes above or below these lines, because these values are not chiseled in stone and I only use them as very rough guidelines. I either way don't like to rely fully on any one of these indices that I show you today, but I rather use them as tools and in context of what is happening economically and politically to see how the overall mood on the stock market is. So when we also look at the VIX in context with the S&P, it becomes very visible that each and every one of these spikes in the VIX relates with a correction in the stock market. Every time the VIX goes up, we see a correction in the S&P, and every time it goes down, the S&P recovers again. Most recently, we have the correction from last August that was related to the end of the carry trade with Japan. Here, the VIX spiked very briefly. Then we see a huge spike of the VIX in 2020 where the COVID crash happened and the market went down by around 35%. But the VIX does not only show these large crashes. It also shows smaller corrections like the 10% dip of the S&P in February 2018 when the market was quite overbought and the fear of rising interest rates pushed the market down a little bit. Even in cases like this, the VIX showed a very sharp spike. But it does not only show these quick crashes with quick recoveries. The same is true for longer corrections or downtrends like the one we had in 2022. Here we had almost 1 full year of choppy markets and a general downturn, and the VIX stayed quite elevated over the whole time period. In this case, we didn't even have a sharp spike, but the levels have been above the 30 mark for quite a while. But the more interesting thing is actually not these longer elevated periods, but what happened to the market right after these huge and sharp spikes like we also saw last week and to some extent still have it today. Because in every case with such a sharp spike we had in the last 2 decades, we had a pretty quick recovery afterwards. We can see this in the data of last August as well as the COVID crash, and in every one of the smaller corrections we had in recent history. But we need to be a bit careful here, because it is not true for every crash, and we really need to distinguish sharp spikes from the VIX from periods where the index stays elevated for a longer time. I already showed you how the VIX looked back in the bear market in 2020, where it stayed higher for quite some time, and when we go back to the financial crisis in 2008 and 2009, where the market crashed by almost 60% over the course of a year, we have a similar picture. In this case, and let's zoom in a bit, the VIX stayed well above the 30 mark for the whole year where the market went down, and then for a half a year again when the S&P has started to rise again. So while we can learn a lot by observing the VIX, it is not a good timing indicator, because we can never know how it will look like tomorrow, and in cases of longer downtrends, the market has gone up significantly again before the VIX has started to calm down. And that brings me to the situation today. Like I said before, we already had this sharp spike last week and it did come down significantly already. But at the moment we are still above the 30 mark, so we are still in rather elevated territory, especially when compared to last year, and we don't know yet where we will go from here. So what's my point with all of this? Well, for one, every spike in the VIX indicated a period of high uncertainty, and there were always good reasons behind every spike and every corresponding dip in the S&P. But after everything had come down, the markets went up again, and in every case in the last 15 to 20 years where we hit these very high volatility levels, like last week, it was actually a good opportunity to buy. Now, you might say that the economic situation 15 years ago was very different from the one today. And you're absolutely right. I actually made a whole in-depth video about this 2 weeks ago that summarizes these differences and also the expectation of fund managers and investment houses for the next decade. So if you're interested in these changes and what it means for us as investors, I'll put a link to it at the end of this video. But for me, as a long-term investor that has no intention of quitting the markets, when I see these levels that we only had a handful of times in the last decade, I'll play the statistics game and say that this is a good opportunity for me to buy. And the second indicator that I want to show to you only emphasizes this opportunity. And this is the index on the percentage of stocks above the 50-day average, or MMFI. It does exactly what its name suggests. It shows you the percentage of stocks that is currently above the 50-day average price. And yes, I admit it. At first glance, this index looks pretty messy, but bear with me. It is not as complicated as it seems. I use this mainly in combination with the VIX to see the impact and the strength of any given correction and to determine where the market is standing after a crash relative to the weeks or the month before. So let's go back to TradingView and plot the VIX here in the lower graph and the MMFI in the upper graph at the same time. Now we can go to times where the VIX has spiked and look at the MMFI. Let's first have a look at the COVID crash. Here we see that at the time of the initial spike of the VIX, the MMFI showed a huge dip, and at its bottom, only about 2.5% of all stocks has still been above their 50-day average. So this shows us that we had a market-wide crash that affected all stocks, and that pretty severely. When we look at the crash from last August in contrast, where the VIX also spiked by even more than last week, the MMFI shows us that in this case, around 30% of all stocks has still been above the 50-day average. The MMFI doesn't give any exact reasons, but I like it because it gives me a feeling of where the market is standing in these times of high volatility, and it shows me the severity of a crash. So in the current case, we see that the MMFI has dipped down to almost the same level as the COVID crash. So currently we do see a market event that, at least in the short time, has a similar effect on the markets as COVID did. And while it doesn't say anything about the detailed valuations or the price of individual stocks compared to the fundamentals, again, as a long-term investor, I just can't pass on opportunities where I can buy basically the whole market at such a discount compared to the weeks before, even in cases where the immediate future of the market is uncertain. And just to show you that I really mean what I say here, I did use the current dip to buy 14 more shares of TSMC on April the 14th with a total worth of 1,940 euros. And let me be very clear here. I don't know where the markets will go next week or next month. But I am pretty certain that it will go up again over the course of the next decade. An analogy by the, at least in Germany, pretty famous Hungarian financial expert and speculator André Kostolany compares the stock market to a person walking their dog. While the human walks at a quite steady pace in one direction, the dog bounces back and forth and all the way around his human. But over a certain time, both move in the same general direction with the same general speed. The dog in this picture is the stock market, while the human is the general economy. Over the long run, both head in the same direction, but while the economy strolls forward at a steady pace, the stock market darts back and forth like an excited dog on a leash, chasing after every distraction. Now, the thing today is that the economy, especially in the US, but also worldwide, might be disrupted with Trump's politics. But the same was true during the COVID crash that also affected the economy pretty severely. And in times like this, it helps me to look at what smart money is doing, which is my third and last indicator today. But before we go there, if you find this video interesting, please don't forget to subscribe and maybe even leave a like. It really means the world to me, so thank you very much. So my last indicator is the smart money, dump money confidence. Smart money are the professional investors and dump money are private investors. And there is actually a big difference between the actions of both groups right now. While the confidence with private investors has gone down severely during the correction in the last 2 months, the confidence of professional investors has actually increased and is higher today than it had been over the whole last year. Of course, fund managers and other professional investors also don't have a crystal ball. But I believe that they are in the game long enough to recognize a generally expensive market like we had it in the last year, and to also recognize when you can get good stocks at a discount. And at the moment, in contrast to private investors, they seem to think that we are currently rather in the discount territory. So all of these three indicators point in the direction that it is currently a good time to buy, especially if you're in the game for the long run. In my own unprofessional opinion, I think that the volatility will stay higher over the next month, at least until the 90 days where Trump paused his tariffs are over. And I also think that there is a risk that these tariffs, if they really come, will disrupt the global trade and affect the global economy. But I also think that these times of higher uncertainty are the times where future millionaires are made. And to say it in the words of Warren Buffett, the price you pay determines your rate of return. So what do you think about these three indicators? Are these already tools that you use for your investments? Please let me know your thoughts down in the comments below. And if you're now wondering what the next 10 years will bring, how the economy today is very different from the one 15 years ago, and why this means that we as investors should expect lower returns in the next few years, this video right here will give you some answers. That being said, thank you so much for watching, guys, and see you in the next video.